Could Treasuries hit 6% or more? And should you buy now or wait? Hello, members, super savers, and bond course fans. I hope you're healthy and well. So T. Rowe Price sure did think that a 6% 10-year T-note yield was possible in their outlook for Treasury yields from December 2024. And T. Rowe Price reiterated their 6% call in this more recent Bloomberg article. T. Rowe sees German fiscal push emboldening 6% U.S. yield call. So we're not at 6% yet, but we have been getting closer this past week as Treasury yields spiked from tariff and overall economy-driven fear, uncertainty, and volatility. Headlines like these didn't help either. From the New York Times, sell-off in U.S. bonds and dollar raises questions about safe haven status. And from the Wall Street Journal, the dollar and the bond market's ominous message for Trump. So, with that in mind, here are the 3 topics that we'll be covering in today's video. 1. Why was the rise in Treasury yields this past week so discomforting and perplexing? 2. Who was selling their Treasuries and why? And as we normally do here at Diamond NestEgg, let's try to go through the facts of the situation, including whether China was possibly dumping U.S. Treasuries. And 3. How high could Treasury yields go, and how might you want to think about this for your own personal portfolio? And as a heads up, today's video will take the place of our normal weekly bond update, and we will have a separate video coming out shortly to cover this coming Thursday's 5-year TIPS auction, as well as our May I-bond rate projection. Remember that there is no rush to pick up those I-bonds. Whether you buy now or a few days before April 30th, you'll still get this I-bond rate here. So let's get back to nominal or non-inflation protected Treasuries for today's video. As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Why was the rise in Treasury yields this past week so discomforting and perplexing? Most Treasury maturities had quite a wild ride this past week. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. And here's the increase or decrease in rates over the past week. Increases in rates are shown in black. The 1.5-month or 6-week was unchanged, but all the other maturities were up, and significantly so for everything 1 year and above. The highs and lows during the week were much more extreme, though. The 10-year yielded intraday as high as 4.5% and as low as 3.86%. The 20-year yielded as high as 5.05% and as low as 4.35%. And the 30-year yielded as high as 4.99% and as low as 4.33%. These are quite wild swings by the standards of our normally more staid and stable government bonds. And the volatility alone, the fact that the yields changed that much in just a few days, was enough to capture the attention of bond investors and the overall market. What made it really alarming, though, was that yields moved in the wrong direction. Normally, when financial markets crash and traders and investors run scared and nervous, U.S. Treasuries are seen as a safe haven, and people rush to buy them to have their money anchored and protected in a sheltered harbor, where that money can ride out the financial storm without much harm, so to speak. And that's what happened at first, immediately after President Trump made his reciprocal tariff announcements on Liberation Day, April 2nd. As the markets tried to figure out what the tariffs meant for the U.S. and the world economy, they piled into Treasuries. And as our bond-savvy community knows, more buyer demand means higher prices for Treasuries, which also means lower yields for investors who are buying, as you can see from the steep drop in yield on the 10-year Treasury after April 2nd. But then something surprising happened. On Monday morning, the S&P 500, the most closely watched index of stocks traded on American exchanges, took another steep downturn. And under normal circumstances, you would expect Treasury yields to continue falling. Because generally speaking, when investors move money out of the stock market during periods of high uncertainty and volatility, they move that money into the safe haven of Treasuries and pushed those yields further down. But rather than going down as expected, the yield on the 10-year Treasury actually went up the next few days, and it continued on this rather steep upward trend over the course of last week. As we showed you earlier, Treasury yields rose practically across the board on all maturities, with the sharpest increases for medium and longer dated maturities. So the market went into a frenzy trying to figure out what was happening. People must have sold Treasuries in large amounts. That much was clear, because only that could possibly explain the skyrocketing yields. But who and why wasn't clear at first, which brings us nicely to the next section of this video. Who was selling their Treasuries and why? Now, one explanation for why people were selling their Treasuries could have been, in theory, that the worst of the crisis was over, that market participants were expecting a return to normalcy, and therefore selling their Treasuries to reinvest the money into higher yielding assets. But this explanation doesn't sound quite right to us, nor to most market observers, because Treasury yields continued to go up and stayed up no matter which direction stocks went. So let's briefly go through what I think are the three primary reasons for the Treasury sell-off and higher bond yields. The first reason is tariff uncertainty and risk of stagflation. Investors realized that President Trump's tariffs were introducing a new element of uncertainty into the economy, raising the possibility of a U.S. recession or even a long-lasting stagflationary environment where the economy doesn't grow, but inflation remains stubbornly high. Maybe they also took it as a reminder of how indebted the U.S. government is, and to compensate for all these risks, investors were demanding a higher yield for the 10-year. The second reason for the quick selling of Treasuries is unwinding of hedge fund base trades. Now, let me first explain what base trades are. Base trades are often described in terms such as a popular hedge fund arbitrage trading strategy between cash and futures Treasury positions, like Reuters explains it. This sounds complex, and it is complex when actually executed in the market with the help of derivatives and sophisticated computer models. But the basic economic idea is easy to describe. Here's a simple base trade illustration. You can often buy a Treasury in the market for less now and sell it in the market for more later. So, for example, today, you may be able to buy a Treasury in the market for $95. And at the same time, you can also buy a future guaranteeing that you can sell the same Treasury in 3 months' time for $96. Now, this phenomenon may potentially point to a certain market inefficiency, but as the investor buying both of these at the same time, you don't really care about that. What matters to you is that there is an opportunity to lock in a guaranteed profit of $1 in only 3 months. So why wouldn't an investor do it, right? Well, that's essentially what hedge funds think. Now, the actual gains you can make from this base trade after the time value of money and all costs, etc., are factored in, are much smaller than the $1 in this simple illustration. It's more like a few pennies or less per trade in reality. These numbers in our example are completely made up and also exclude details on the complex derivative strategies that would normally be used in such situations in order to explain the thinking behind a base trade in a way that everyone can understand. That said, the base trade works in real life if properly executed, and so various hedge funds have poured substantial amounts into such base trades. According to Reuters, Apollo Global Management estimates that the base trade market is currently worth around $800 billion. Here's the thing though, this base trade works best when markets are normal. When markets become too volatile and uncertain, when markets get disrupted, as professional traders often say, the opportunity to do base trades disappears because no one will guarantee you a higher price for your Treasury in the future, uncertain as it looks in such times. And when the base trades stop, the $800 billion or so that were allocated to them will shift to other investment opportunities or even just be parked in cash. And this means that one big $800 billion source of demand for Treasuries will disappear, depressing their prices and pushing yields higher. It's also important to note that the base trades already stopped once before, at the beginning of COVID in 2020, and are thought to have been a major contributor to the Treasury crash that happened back then. Some in the market believe that if the Fed had not stepped in, Treasury market liquidity would have suffered further as a result of the standstill in base trades. Moving on now to the third reason for the Treasury sell-off and yield spike: selling by foreign holders of U.S. debt. Markets have long been afraid of what traders love to call China's nuclear option of dumping their holdings of treasuries on the market to depress prices. And some voices suspect this might have been happening earlier this week, as Bloomberg reports. China may be selling them in retaliation for tariffs. Now, we don't have the data to prove or disprove this hypothesis in real time, but some selling of treasuries by China would fit the long-term trend. As you can see from this red line here, China has been reducing its holdings of treasuries slowly but steadily for about 10 years. However, in our opinion, we should be careful before attributing too much impact to potential selling by China. While China is the second largest foreign holder of treasuries behind Japan, China only owned about $750 billion of them at the end of last year, a mere 2.6% of the almost $29 trillion of treasuries outstanding. As a bit of perspective, China's approximate $750 billion of treasury holdings is less than the estimated $800 billion allocated to base trades that we just talked about, which may be more active and impactful in the market. Now, China may still be selling some of its U.S. treasuries, potentially, but are they doing it because they want to hurt the U.S. or because they need the cash for their not exactly booming economy? Or perhaps it's a bit of both. Check out this China versus the U.S. video here that we just posted yesterday, if you're interested in our take on the current trade and tariff war between the two countries and who may actually be winning. I've also linked it below in the first pinned comment for your convenience. The point is that just China selling its treasuries, even if true, may not be enough, at least in our mind, to explain this rapid rise in yields. But we do think that some selling by foreign owners of treasuries might be happening, and it may not just be the Chinese. Even countries who are our friends, like the Japanese and the Europeans, may be inclined to sell some of their U.S. treasuries to bring their money back home in their local country and currency. This would be an entirely natural reaction in turbulent times like these. As Bloomberg reports, in the week through Wednesday, foreign domiciled U.S.-focused funds saw a $6.5 billion outflow, the second biggest since at least 2020, according to EPFR. EPFR is a Boston-based provider of fund flows and asset allocation data. What this means is that funds that are domiciled or located and managed out of foreign locations, such as Frankfurt, Germany, but invest in U.S. assets, such as treasuries, saw withdrawals of about $6.5 billion in the week through last Wednesday. Now, this isn't that large an amount in the bigger scheme of things, but it could be an indication that, let's say, some German investors got nervous and sold their treasury funds that they had bought from a local provider such as Deutsche Bank. And it appears this may be what is actually happening, in my mind. Here we have the yields on the 10-year treasury, the 20-year treasury, and the 30-year treasury, all of which have spiked over the past week. Meaning, holders of U.S. government debt are selling and pushing down those prices. Again, remember the inverse relationship between bond prices and bond yields. Investors sell, push bond prices down, and bond yields go up. But where's that money going if Jen is correct with her theory, you might ask? Well, it seems that at least some of that cash may be going into German government bonds, Bunds for short, as traders call them. Here's the yield on the 10-year Bund since April 4th, the yield on the 20-year Bund, and the yield on the 30-year Bund. Down, down, and down, indicating that there was more demand for them than usual. As I said earlier, it appears that European investors may be bringing some of their money home from the U.S. And as I also said before, this would be completely expected and even normal behavior given the global upheaval with trade and tariffs at the moment. And Reuters seems to think the same. Much of the additional money that flooded into America's relatively high-yielding bonds over the past decade was mostly from Europe, and scared money tends to go home. So, tariff uncertainty and risk of stagflation, the unwinding of hedge fund base trades, or similar trade unwinding for that matter, as well as foreign holders of US Treasuries selling some of their holdings. These taken together are three primary reasons for the Treasury sell-off and the higher bond yields, I believe. Now that we have a suspicion about which parties may have been selling Treasuries and why, let's move on to the next section of today's video. How high could Treasury yields go, and how might you want to think about this for your own personal portfolio? So going back to the possibility of a 6% 10-year T-note from T. Rowe Price's outlook for Treasury yields that we shared at the beginning of this video, the strategic factors in favor of higher longer-term Treasury yields that they analyzed in their outlook remain mostly valid, and in some cases even more so now than when they first published this piece. Here's why a 6% 10-year Treasury yield may be a real possibility. First, and in the words of T. Rowe Price, U.S. fiscal expansion persists, which is a nice way of saying we'll see more budget deficits. Now, the federal budget for 2025 is not approved yet. It's running late, as in so many years before. At the time of this taping, both the House and the Senate have approved an outline, but the details will still need to be worked out across both chambers in the so-called reconciliation process before the final bill can go to the president for his signature. And we expect more haggling and fighting as the process continues. But the Nonpartisan Committee for a Responsible Federal Budget is already sounding the alarm about what's in this draft. This budget sets the stage for the largest deficit increase in history, an unprecedented bill that requires just $4 billion in savings to offset up to $5.8 trillion in deficits. What an absolute disgrace. And they continue, attaching such a debt blowout to the largest specified debt ceiling increase in history, $5 trillion, just adds insult to injury. Second, inflation may trend upwards again, forcing interest rates up as well. Both the continuing fiscal deficits as well as the new tariffs are expected to lead to higher inflation, which in turn would lead to higher interest rates on the short end and possibly higher Treasury yields on the long end, assuming that we can avoid a deep recession. And the third factor speaking for higher Treasury yields is that foreign demand for U.S. government debt may continue to fall, as may have happened this past week. In fact, it has been going down for a while in relative terms. Foreigners have reduced their share of outstanding treasuries from above 50% in 2013 to just a little bit more than 30% now, which means, of course, that the remaining investors may be able to demand higher yields to keep up their treasury purchases. Of course, nothing is guaranteed, and the future is hard to predict, and it could all end up differently. So let's look at some of the factors that could keep treasury yields where they are, or even make them come down. First and foremost, a slowdown or recession in the U.S. economy would almost certainly put pressure on the Fed to lower rates. Now, if we were to enter a stagflationary period where a slowing economy was combined with persistently high inflation, the Fed might prioritize the fight against inflation and keep rates higher. But still, a slowdown of the economy is probably the biggest factor that could lead to lower rates. In addition, there are some technical factors that could play a role in keeping Treasury yields lower than they would otherwise go. For example, the recent changes in Fed regulations that could encourage banks to hold even more treasuries on their balance sheet. Or if the Fed were to change course on the ongoing shrinking of its balance sheet, for example, due to political pressure. And let us not forget that Treasury Secretary Scott Bessent is on record as saying he is focused squarely on getting the 10-year yield down. I'm not quite sure how he wants to achieve this at this point, but it is something we should keep in our mind. And one more remark. The last two Treasury auctions for the 10-year and the 30-year went better than expected and saw a lot of demand, which might be another indicator that investors aren't fleeing treasuries completely, which could, in principle, argue for lower rates as well. So what does all this mean for our money, right? Well, as I told our members in the special member live from last week, as treasury yields were surging, link below in the first pinned comment for those of you who may have missed it. So many in our Diamond NestEgg community often ask me the question, will treasuries cross 5% or 6%? Well, some treasuries did cross 5% this past week, even if only briefly, and some of you were thrilled and picked up a few. At least one of our members even celebrated her first secondary market purchase to grab these higher yields while they were available. At the same time, though, others in our community were wondering if treasuries are still safe and whether they should sell because other investors are dumping treasuries. Here's how I think about this in general terms. If you fundamentally believe in America's economy and assume that our country will not default on its debt, then the 5% and possibly even 6% yields may be buying opportunities for you if those maturities fit your circumstances, goals, and expectations. In the words of Warren Buffett, be fearful when others are greedy, and greedy when others are fearful. And if you're fundamentally optimistic about America's economy, but maybe a bit concerned about inflation, then stay tuned for our I-bond versus tips video, which will be coming shortly. Now, if on the other hand you don't believe in America's economic prospects, or you think that a U.S. default is inevitable, then you probably shouldn't be buying any treasuries at all. As our Diamond NestEgg regulars know, I'm personally with Warren Buffett in the never bet against America camp, and my standard assumption continues to be a no default scenario on treasuries. And I think that there will be quite a bit more volatility to come. These tariff and trade talks will take a while to hash out, meaning that in all likelihood, yields may see further spikes upwards, even if potentially only temporarily. So given that we already picked up a few 5% plus 20-year T-bonds earlier this year, I'm going to wait things out in the hope of even higher treasury yields. And if that doesn't work out, well, we'll just leave our cash as dry powder in our T-bill ladders and money market funds and wait for another opportunity, either in fixed income or equities. But again, that's us with many, many years to retirement. And as I always say, everyone's financial journey is different. What about you? Did you manage to pick up any 5% or nearly 5% longer dated treasuries last week on the secondary market? Or were you a part of the 10-year and 30-year treasury auctions? Or are you steering clear of treasuries for the time being? Drop a comment below and let me and the community know. All right, members, super savers, and bond course fans, I hope you enjoyed this video and learned something new. And as always, if you want to learn more about how to build a stable, predictable income stream in times of market uncertainty and volatility, then check out this video here on our bond courses. And come join our next live member Q&A on Saturday, April 19th at 5 p.m. Eastern Time, 2 p.m. Pacific Time. We'll be diving deeper into the 2, 5, and 7-year T-note auctions and all things fixed income. I've also linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. And see you again very soon with more brand new wealth building content for your financial journey.